The problem with the most expensive mistakes in retirement isn't that they're complicated, it's that they're invisible. They happen quietly, in the background, while you're living your life and managing your finances the best you know how. And by the time you discover them, sitting across from a tax preparer, or opening a letter from the Social Security Administration, or logging into Medicare to check your premium, the damage is already done. The income event that triggered the trap happened 6 months ago, 2 years ago. The tax bill is already calculated, the Medicare surcharge is already locked in, and there's often nothing you can do to reverse it. This is what makes the 5 retirement tax traps we're covering today so important to understand before they catch you, not after. The problem isn't usually one big mistake. It's a series of small, confusing rules that interact in ways most people don't notice until after the tax bill arrives. Let's break down the 5 retirement tax traps before they cost you money in 2026. Stay with me all the way to the end. Welcome to Professor Kingsley. If you're new here, please hit that subscribe button right now and turn on your notification bell. We put out new content every single day, and the traps we're covering today are ones that are actively costing retirees money in 2026. Trap number 1 is the one that most retirement planning conversations never fully explain: the cascading tax chain reaction that happens when required minimum distributions begin. Required minimum distributions from traditional IRAs and 401ks often catch retirees off guard, not because they forgot to take them, but because of what those withdrawals trigger. RMD income increases your adjusted gross income, which can push you into a higher tax bracket and increase how much of your Social Security gets taxed. Even modest distributions can have a large impact, especially if multiple income thresholds are crossed in the same year. Here's the specific chain reaction that plays out in millions of households at age 73. You're taking your first RMD. Let's say the distribution is $25,000, which is not unusual for someone with a few $100,000 saved in a traditional IRA. That $25,000 goes directly into your adjusted gross income. Now your AGI is higher. A higher AGI means more of your Social Security benefit becomes taxable, up to 85%, depending on where your combined income lands relative to the provisional income thresholds. And those thresholds, which haven't been adjusted for inflation since 1983 and 1993 respectively, are low enough that millions of retirees are now in the 85% tier without realizing how they got there. So you have ordinary income tax on the RMD itself, plus additional Social Security taxes triggered by the higher income. 2 tax consequences from one distribution. And then the third consequence arrives 2 years later: the IRMAA Medicare Premium Surcharge. Because Medicare uses your income from 2 years prior to determine your premiums, the year your RMD pushes your income above the IRMAA threshold, your Medicare premiums go up, not immediately, but 2 years later, in a way that feels disconnected from the original income event. For 2026, the standard Medicare Part B premium is $200 and $2.90 per month per person. For single filers whose 2024 MAGI exceeded $109,000, that monthly premium jumps to $284.10. The highest income tier faces a monthly premium of $689.90 per person. A single income spike from a large RMD, a Roth conversion, or selling a property can create a Medicare premium surprise later. A retiree who exercised a significant amount of stock options or took a large distribution saw everything feel normal afterward, but then Medicare looked back 2 years and the surcharge hit. The way to address this trap is through proactive RMD management. The most powerful tool is the qualified charitable distribution, transferring up to $111,000 per year directly from your IRA to a qualifying charity, which satisfies your RMD obligation completely while excluding the distributed amount from your taxable income. No income tax on the RMD, no impact on Social Security taxation, no impact on IRMAA calculations. The money goes from your IRA directly to the charity without ever touching your AGI. That's the cleanest single tool available for managing the RMD chain reaction. Trap number 2 is one that 2026 has made more dangerous than it's ever been, and it's one of the most misunderstood cliffs in all of federal policy. It's the IRMAA Medicare premium cliff, And the critical word there is cliff. IRMAA isn't just a trap, it's a cliff. Unlike income tax brackets, which are marginal, if you earn just $1 over the IRMAA tiers, your Medicare premiums are probably going up. This distinction is enormously important, and almost nobody explains it clearly. In the regular income tax system, if you're in the 22% bracket, only the income above that bracket's lower threshold gets taxed at 22%. The system is graduated. The cliff doesn't exist. But IRMAA doesn't work that way. It works in tiers. And the moment your MAGI crosses the threshold into the next tier, even by a single dollar, your entire Medicare premium jumps to the rate for that tier. For 2026, the IRMAA brackets impose Medicare surcharges of $1,148 to $6,936 per person when MAGI exceeds $109,000 for single filers or $218,000 for joint filers. Because IRMAA uses a 2-year look-back, income decisions today affect premiums in 2028. Let's make that concrete with a real example. Meet a married couple, both on Medicare, with combined MAGI of $258,000. They're already in IRMAA Tier 1, which means their combined annual surcharge is $2,297. The husband wants to do a Roth conversion. The question is, how much can he convert without jumping to Tier 2? The calculation is straightforward. Tier 2 begins at $274,001. He's at $258,000. That gives him $16,000 of what planners call IRMAA room, the maximum he can convert without triggering the next tier's higher surcharge. Convert $16,000 and they stay in Tier 1. Convert $60,000 and they jump into Tier 2, with a significantly higher combined annual Medicare premium. There's also a trap within the trap that specifically affects surviving spouses. A married filing jointly couple paying $218,000 combined MAGI falls below the first IRMAA tier. But when one spouse dies, the survivor must file as single, meaning the same household income now triggers IRMAA, because the single threshold is only $109,000, exactly half the joint threshold. That widow or widower has their filing status change, their household income stay essentially the same, and their Medicare premiums potentially double, all in the same year, at precisely the worst possible emotional and financial moment. The 2-year look-back is the rule that makes IRMAA planning require the longest runway of any retirement tax decision. Your 2026 IRMAA is based on your 2024 MAGI. Your 2027 IRMAA is based on your 2025 MAGI. For someone applying for Medicare in 2026, they would have needed to complete Roth conversions by 2024 to avoid the look-back period, creating a premium impact. That's how far ahead the planning needs to happen. If you've had an unusually high income year, a home sale, a large IRA distribution, a stock exercise, and your income has since dropped, you may be able to appeal your IRMAA determination using Form SSA 44, which allows the SSA to use a more recent, lower year's income instead. Trap number 3 is the newest one on this list, one created entirely by a misunderstanding about a benefit that was introduced in 2025, and it's already causing real planning errors in 2026. It's the false assumption that the new $6,000 senior bonus deduction reduces your Medicare IRMAA exposure. Seniors who believe the $6,000 senior bonus deduction reduces their MAGI for IRMAA purposes are in for a surprise. The senior bonus deduction may be lower than expected due to income phase-outs, indirectly resulting in an overall increase in Social Security benefit taxes. Here's what's actually happening with the enhanced senior deduction. For taxpayers 65 and older, the One Big Beautiful Bill created a new $6,000 deduction, $12,000 for qualifying married couples, available for tax years 2025 through 2028. It's real. It reduces your tax bill 28. It's real. It reduces taxable income. It reduces the tax you pay on whatever portion of your income ends up being taxable. It's a meaningful benefit for qualifying seniors. But here's the trap. The senior bonus deduction doesn't directly cut the income figure that the Social Security Administration uses to calculate IRMAA. To understand why, you need to separate 3 moving parts: how the bonus deduction works, how IRMAA is calculated, and what does and doesn't count in modified adjusted gross income. The standard deduction, the extra over 65 deduction, and the new senior bonus deduction don't reduce AGI. They operate below the AGI line, which is why they do not directly lower MAGI for Medicare IRMAA. A simple example brings this home. Imagine Susan, 67, a single filer on Medicare. In 2025, her adjusted gross income is $90,000. Because she's over 65 and under the phase-out ceiling, she qualifies for the full $6,000 bonus deduction. That lowers her 2025 taxable income and reduces her federal tax bill for the return she files in 2026. But her 2027 Medicare premiums will still be based on her 2025 MAGI of $90,000 before any standard deduction, extra over 65 deduction, or the new senior bonus is applied. Those deductions don't change the AGI/MAGI number that Social Security uses for IRMAA. So the bonus deduction cannot, by itself, pull Susan below a Medicare surcharge threshold. The deduction reduces your tax bill. It does not reduce the income number used to calculate your Medicare premiums. Those require the strategies that work above the AGI line: QCDs, Roth conversions, and careful withdrawal management. Trap number 4 is the one that looks most innocent on the surface and that causes some of the most lasting financial damage over a full retirement. It's taking large, one-time distributions from traditional retirement accounts without modeling the multi-year ripple effects. A single income spike can affect taxes, Medicare costs, and benefits for years to come. Converting accounts or taking large withdrawals without looking at the multi-year view can create a ripple effect retirees might not plan for and cannot easily undo. Each of these may be the right move for your situation, but the timing of that move determines whether you'll pay standard premiums or thousands more. Here are the specific one-time events that trigger the longest and most expensive ripple effects. A large Roth conversion, beneficial for long-term tax planning, pushes MAGI up in the conversion year, potentially triggering IRMAA surcharges 2 years later. A home sale where the gain exceeds the exclusion, $250,000 for single filers, $500,000 for married couples, adds capital gains to MAGI in a way that can spike into IRMAA territory, even for retirees who are otherwise entirely below the threshold. A large inherited IRA distribution, taken all in a single year rather than spread across the 10-year window. Selling a rental property or business interest in a single tax year. What all of these events have in common is that they're treated by the IRMAA system the same way regular ongoing income is treated, but they're one-time, not recurring. A retiree who earns $60,000 per year in normal retirement income, but who sells a vacation home for a $150,000 gain in one specific year, is suddenly treated by Medicare as though they earned $210,000, and their premiums for the following 2 years reflect that high-income year, even though the underlying financial reality is their normal $60,000. The strategies that address this trap are sequencing, timing, and awareness. Sequencing means withdrawing from taxable brokerage accounts first, then traditional IRA/401k accounts, and finally Roth accounts, because each step of that sequence creates a progressively smaller MAGI impact. Timing means not taking large discretionary distributions in years when you've already had a high-income event. And awareness means modeling the multi-year view before executing any major financial transaction, so you know what the IRMAA consequences will be 2 years downstream. Trap number 5 is the one that ties everything together, and it's the habit of thinking about your retirement taxes 1 year at a time rather than as a multi-year picture. This is the meta trap, and every specific trap we've discussed today is a symptom of it. Perhaps the most overlooked retirement tax trap is failing to think beyond the current tax year. A single income spike can affect taxes, Medicare costs, and benefits for years to come. Pensions, Social Security, and IRA withdrawals may require manual withholding adjustments. Retirees who rely on estimated payments or forget to update withholding may face penalties, even when they thought they were being cautious. The most important concept in managing retirement taxes over the long term is what planners call the conversion window, the gap years between retirement and when required minimum distributions begin at age 73. In the conversion window, your taxable income could be at its lowest. This can be the ideal moment to convert funds from your traditional 401k or IRA into a tax-exempt Roth IRA. You'll pay tax on the conversion while you're in a lower tax bracket, but that money will grow tax-free in the Roth account and will not count toward future IRMAA calculations when withdrawn. For new Medicare enrollees retiring at 65, their first year of Medicare premiums is based on their MAGI when they were 63 years old. That 2-year look-back means the income decisions you make at 63 affect what you pay for Medicare at 65. The income decisions you make at 71 affect what you pay at 73. And once RMDs start at 73, the window for the cleanest Roth conversion years narrows, because every year now has mandatory taxable income on top of any conversions you might want to do. The way to think about this is a multi-year map. What does your income look like at 63, 65, 67, 70, 73, 75? Where are the low-income windows? Where are the years when RMDs, Social Security, and pension income stack up? Where is there room for a conversion that stays within the 12 or 22% bracket without crossing an IRMAA tier? Those are the questions that multi-year retirement tax planning answers, and they're questions that single-year tax filing never even asks. Now let me give you the practical framework for protecting yourself from all 5 traps, organized as actions you can take right now. Action 1. Look at your projected income for this year and calculate your MAGI. Not just your taxable income, but your modified adjusted gross income, which includes your AGI plus any tax-exempt interest. Compare that to the IRMAA thresholds for your filing status: $109,000 for single filers and $218,000 for married joint filers in 2026. Know your IRMAA room, how much additional income you can take before crossing into the next tier. That room determines how large your Roth conversions or discretionary distributions can be this year. Action 2. If you are 73 or older and charitably inclined, execute your RMD through a qualified charitable distribution rather than a regular withdrawal. Up to $111,000 per person in 2026 can be transferred directly from your IRA to a qualified charity, satisfying your RMD obligation without touching your AGI. This is the most direct way to neutralize the RMD chain reaction. Action 3. If you are in the gap years between retirement and age 73, map out your conversion window. What are your projected income amounts for each year between now and when RMDs begin? How much can you convert in each year while staying within the 12 or 22% bracket without crossing an IRMAA tier? Spread conversions across multiple years to gradually move money from traditional to Roth at the lowest possible tax cost. Action 4. Before executing any large, one-time financial transaction, a home sale, a large distribution, a significant Roth conversion, model the 2-year IRMAA impact explicitly. Don't just ask what the tax will be this year. Ask what your Medicare premiums will be in 2 years as a result of this transaction. If crossing into a higher IRMAA tier would cost you more in 2 years of elevated premiums than the benefit of the transaction itself, the timing deserves reconsideration. Action 5. If you received a large one-time income event in 2024 or 2025, and your income has since dropped significantly due to retirement or a life change, file an IRMAA appeal using Form SSA 44. This form allows you to request that the SSA use a more recent, lower income year to calculate your premium. Approval rates for legitimate life-changing events are high, but the form has to be filed, and the appeal has to be initiated. This is one of the most underutilized planning tools in all of retirement finance, and most retirees don't know it exists. Action 6. Review your withholding elections. Unlike wages, retirement income sources don't always withhold enough tax automatically. Make sure your IRA distributions, pension payments, and Social Security checks have withholding elected that reflects your actual tax liability, not the default 10% that IRA custodians use unless you instruct otherwise. Here is the truth about retirement taxes that I want to leave you with. Retirement was supposed to be simpler. Most people expect it to be simpler. But in reality, retirement income brings a unique set of tax dynamics. The provisional income formula, IRMAA, RMD chain reactions, the withdrawal sequence, the conversion window, that interact with each other in ways that require proactive, multi-year thinking, not passive annual filing. Many retirees are surprised by how easily taxes, Medicare premiums, and income rules can collide, especially as new thresholds and planning pitfalls take shape in 2026. The problem isn't usually one big mistake. It's a series of small, confusing rules that interact in ways most people don't notice until after the tax bill arrives. You now understand those rules. You know the 5 traps, and you have 6 specific actions you can take to protect yourself from them. That puts you in a fundamentally better position than most retirees in America. Before you close this video, please share it. Think of one person in your life who is retired or within 5 years of retirement who hasn't thought about IRMAA or the RMD chain reaction or the multi-year picture of their retirement income. Hit that share button right now and send this to them. It takes 3 seconds and it could save them thousands of dollars that they don't even know are at risk. And drop a comment below. Tell me, which of these 5 traps hit you the hardest? Were you aware of the IRMAA cliff? Did the $6,000 senior bonus deduction and IRMAA interaction surprise you? Are you currently in the conversion window and trying to figure out how to use it wisely? Tell me where you are. I read every comment, and the Professor Kingsley community is one of the most informed and engaged groups I've had the privilege of connecting with. Your questions shape every video I make. This is Professor Kingsley. Stay one step ahead of the traps, and I'll see you in the next one.